The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making the final decision. Arrowside Capital and guests on the podcast are invested or may seek to invest in companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. Currently, Arrowside Capital holds positions in The Trade Desk, Appfolio, and NVIDIA, which are part of this discussion. Hello, welcome everyone to the Hidden Value Creation Podcast, where we discuss aspects of companies that are important to the success of the companies, but maybe not obvious to all that look in from the outside. This time, I'm speaking with Igor Becker, founder and CIO of 42KM Investment Partners. Igor and I are good friends and share a passion for looking at high-quality companies and companies that have very unique aspects to them that allow them to compound over long periods of time. Today, we are going to be discussing company culture and its impact on long-term value creation. I consider Igor to be an expert on company culture. He uses it very extensively in his investment process. He's written articles about it and is always very insightful anytime we have a conversation about culture. So I'm really happy that he decided to come on. He agreed to come on and talk with us today. So welcome, Igor.
Thanks, Tucker. It's a pleasure to be here, and it's great to be able to get together and talk about a subject that I'm passionate about. Happy to jump in.
Yeah, great. So maybe it'd be good if you could spend a minute or two on your background and maybe just a little bit of a blurb on your company.
Yeah, perfect. Okay, so Igor Becker, I'm the founder and PM at 42KM Investment Partners. 42KM, or 26.2 miles down in the US, is a marathon, and I think there's a lot of parallels between long-distance running and long-term investing, like discipline, grit, and humility. So I'm a runner, and it's a large part of my investment process. Going all the way back, my journey began in Ukraine. I was born and raised there. And having grown up behind the Soviet Iron Curtain really shaped my views on risk, resilience, and opportunity. Came to Canada in the mid-90s. I was 16 years old and knew only basic English, which I improved considerably by watching Seinfeld and Friends. So about 5 years later, I started in the investment business in equity research, covering telecoms, and 5 years after that, joined Ontario Teachers Pension Plan, which is one of the largest institutional investors globally. And that's where I've spent most of my career. I grew up there, developed my investing style, and met a bunch of folks that I'm friends with today. About 2 years ago, I left Teachers to open 42KM to focus on culture-led long-term investing, which is a continuation of my journey as an investor. So that's a little bit about me.
That's great. We could probably do a whole separate podcast on the culture within Seinfeld, but that'll be for a different time.
That's right.
So thanks for that. And so maybe why don't we start out because the word culture is an often used word, but maybe people have different definitions. But it would probably be good. Let's level set it, and why don't you give us your definition of culture so we all are thinking sort of along the same lines there.
Yeah, I mean, I think you're right. A lot of people talk about this, and it's a pretty common term. But I think what you find very quickly is that typically people can talk about it for 30 to 60 seconds, give you some throwaway comments around the values that are on the wall, and then they kind of stop. And I think there are very few who are thoughtful and deliberate about going deeper into subject matter and actually figuring stuff out. I think my working definition of culture is how things get done within the company, how people are rewarded and behaviors are incented, I think ideally, the values on the wall match up with the behaviors on the shop floor, so to speak, right? I think the culture is a topic that is not necessarily an exact science. That's why there's a lot of nuance and context-specific work that needs to be done around it. But it's also a lot of fun because it has to do with people, behavior, psychology, and that kind of thing. Yeah.
Yeah. Yeah, I think that's a great working definition, and often it gets confused with things like offsites and foosball tables, and happy hour. I mean, that can help build a culture, but that's not culture, right? Culture really is about what are the things that how do people feel when they come into work each day to drive the collective goals forward, right?
Yeah, I think it's spot on, and I think it was Bill Markin who said it well. Like, culture is how employees' hearts and stomachs feel on Sunday night about Monday morning, and I think it really encapsulates the message well. And I think both of us have been in different firms and situations where we experience the importance of that alignment, as you said.
Yeah, absolutely. I guess for investors or people that are curious about it, like, how do you analyze culture from the outside?
Yeah, so that's a $64,000 question, right? How do you do it? There's different ways of approaching it. The framework that I got comfortable with is based on outliers or anomalies. Essentially, looking for things that the company does differently, either consciously or unconsciously, relative to their peers and industry competitors. So these anomalies can be found almost anywhere, from the language that the company uses to talk to not only investors but employees and other stakeholders. It could be the way that the company behaves during tough periods, right? Whether it's COVID or natural disasters. There are choices around balancing long-term with the short-term. Incentives. How do they pay their people? I think the other one too is how often they change their leadership and strategic direction, and we'll definitely talk more about that. But there's enough information out there where you can kind of create this cultural mosaic of different outliers to either support your initial thesis or disprove it, right? So that's kind of at a high level, but we can kind of dive into any part of that process.
Yeah, I think that makes a lot of sense, and I mean, maybe also to continue on that. We want to talk for a minute about why culture is so important to you in your investment philosophy and process.
Yeah, I mean, I think I kind of learned the importance of culture early. When I was only starting out in Canada, I got a part-time job I wasn't picky about what to do, and it was a demolition company that paid a bit more, so I kind of jumped on the opportunity. And when they were removing, stuff from the walls, I kind of asked, well, what is it? And they said, listen, you're not here to ask questions, just do your work. And then we later found out that it was actually asbestos, and they didn't have any masks or anything like that. And it's kind of like, well, and the owner knew about it. So that to me really kind of set the tone around, what kind of business that was. And then much later, as an investor, I always kind of like the angle of, quality, doing the right thing, and the angle of long-term time horizon. And one of the lenses that I really liked is culture and alignment of that to the other factors of the business. And I think it's really intuitive, why it's important, all right? Because the way it's actually kind of the frameworks that you use to make decisions, right? Whether it's capital allocation, risk management, strategy, tactics, it permeates a whole decision-making process. And so over time, you see the culture reflected in the actual results of the company and the consequences of their decisions. So you can actually, build a timeline, see that through, and then, make your analysis. So to me, I think it's probably the most important single factor, and a very useful lens to supplement the classic fundamental analysis that you and I use to analyze companies. What do you think?
Yeah, no, I think it's a great point. I am a big proponent of trying to understand really well. Once you've done the work on a business and the quantitative work that I use at the front end of my process, occasionally I'll come across a company's financials that'll just scream to me, hey, these folks really know what they're doing. They've got this figured out. And then it becomes, to me, it's sort of an exploration of, okay, yes, it's the products, it's the service, right? That matters. But I think the thing that you can't get out of the numbers is the people and the people that are making it happen. Because at the end of the day, anyone who's worked at a company knows it's the people that drive the company. The product is important, but it's the people that drive the customer experience and innovate and do all the things that are necessary to keep the company growing. And so, yeah, I totally agree. And I think that it is one of the things that is hard to know from the outside. But to me, I think the consistency part is just as important, because if the management team has done a really great job to date, all company outcomes are probabilistic from whatever day you look at, right? So from today, company outcomes are probabilistic, but you have a higher probability if you've got a great product, service, et cetera, but a great culture to be able to repeat what's been seen.
Yeah, no, absolutely. I think that's a great insight. And I would add that what makes it a little easier to analyze a company from outside in is if you know them well and you've covered them for a decade plus. Then you have that level of baseline of what's normal and what are the deviations from normal, as opposed to you're just picking up a new stock and you're kind of like, oh, here are all these interesting factors. Well, maybe they are, they've always done it that way or not. So you need to have that background that you kind of build over time.
Yeah, absolutely. And I think the other thing too that I think, it was something I wasn't taught early in the industry, and I didn't appreciate, because, without a ton of experience, you probably wouldn't know it or feel it. But these companies, even like when you get a bear market or you get an economic downturn, these companies are still doing their thing. Like, they're still trying hard to continue to create value. And it's the ones that are coordinated, that have a good culture, that are able to get through difficult periods, which are the ones, those are the real gems in the portfolio if you're looking at it as an investor.
Yeah, no, absolutely. And I think those are like these tough periods are one of the best analytical hunting grounds for these anomalies, right? And I think my experience as well has been that usually these exceptional compounders are they can't predict what's going to come, but they're very well prepared in their responses and their scenario analysis of how they deal with those crises, as opposed to some of the competitors are being reactive and doing it on the fly, which makes a lot of difference on the downside and a lot of, and can generate a decent amount of alpha.
I think that's a really important point. The best long-term value creators are the ones who are prepared and not reactive. They do have to react to what goes on, but they don't do things sort of impulsively or reactively. They do it based on, just long-term knowledge of the industry and their customer, and react to the current set of circumstances.
Yeah, no, I think that's right. And I think one of the myths or misconceptions about these companies that focus on the long term is that, they have a strategy and they care about kind of the next, 20 years, and they don't care about what's going on in the next 2. And I think that's flawed. Some of the best companies have this dual time horizon, which is really tough, but it's now and forever. Right, and so there's this interaction and maybe a bit of a natural tension to give attention to both, but the very best are able to balance it.
Yeah, absolutely. Well, let's talk about a few companies. Let's put it to the test on practical application. So, what are a few companies that really stand out to you as having a culture that's clearly different and leads to results that are clearly different?
I think so. There are a few. The one that I might start with is Hermes, and it's a French luxury manufacturer. And I think they're an interesting case. They've been around for 100 odd years, and really have proven out their chops, so to speak, in generational perspective, right? It's I think it's maybe 5th or 6th generation of the family that runs the company. They've had the same investment philosophy, sorry, not investment, but product philosophy of being master artisans. This sort of Parisian perfectionism and highest quality. They've been very clear around their preferences of pedigree over profits, and survived a couple of moat attacks. Right, the first time when the car replaced the horse, they adapted and started making handbags, because initially they were doing a product like equestrian products, and then in the 70s, when the quartz crisis, that affected watches and fashion accessories kind of came in, and there was a preference to switch from higher price materials to something that is more casual. They adapted as well. And you can kind of see it across different elements of the firm. Like 40% of their workforce are craftspeople. It takes years to become one. Like it takes 8 years to become master artisan. They have schools where they teach people to do that kind of thing. The result is that their incredible scarcity for their product, and they've been able to stay on the top of the luxury pyramid for some time, while sort of innovating around the edges. So that's maybe one that I'd start with.
Yeah, it's a great example. The other one thing that stands out to me when I think about that company is brand. It's got a pretty iconic brand. And when you think about their culture and their brand, how intertwined do you see them, and like what kinds of behaviors do you witness in the company that pulls those together?
Yeah, that's a really great question, and I think an episode that I've heard, an anecdote that I've heard about them, kind of illustrates it well. They had a really hot, handbag selling in Japan. I think it was maybe a tote bag, kind of a casual one, and it really started selling in quantities that they didn't expect. And instead of kind of promoting that and manufacturing more, they decided to withdraw from the market and just close it down because they were worried that this kind of mass production might jeopardize that pedigree and that brand that they've built over 100 plus years. And from what I've heard, when the CEO presented this episode to the board, he got a standing ovation, and there were no sort of qualms about it was a pretty clear course of action of what needs to be done. So I think there you can kind of see the the intertwinedness of culture and brand.
Yeah, there is a temptation. I guess that's one of the things that I think I've learned in investing in consumer companies is that there's always the temptation to get more, right? More revenue, more profits in the very short term. But it always has an expense. So that take for example, if you have a great brand, but then you put out a product that isn't up to the standard that the customer considers the brand to be, you've already deteriorated the brand. You might have sold more goods, and maybe those goods were more profitable than your average, but in the long term, it sort of, it will come back to bite you. And so, yeah, that's an interesting anecdote on, holding back when they clearly could have sold a lot more in the interest of protecting the brand in the long term.
No, that's a great point. And I think that cost of hurting the brand is orders of magnitude higher than you could ever hope to make. Because if you look at, and I don't have the numbers in front of me, but I assume if you look at Hermes's book value relative to market value, that delta of goodwill is many, many billions, and hurting that sort of sacred concept is just a non-starter.
Yeah, and it's a behavior that you have to have a lot of confidence in your strategy, and you have to have total buy-in. I guess that also, plays a big role in culture, right? Is the buy-in piece, where leadership is basically, in this case, they're saying, we want to have this brand be associated with high quality and exclusivity rather than mass production. And then you have to get everyone to buy in, because at the end of the day, they need to share the same vision.
That's spot on, right? And that is exactly that is actually where you could kind of hunt for anomalies as well, right? Whether what the CEO is telling the investor community actually is supportive is how they attract, train, and retain talent, right? In Hermes' case, it's the master artisans, which is the driving force of the firm in terms of people who produce the goods, and how thoughtful and serious they are about that element of their business.
Yeah, absolutely. Any other companies come to mind that you'd highlight?
Yeah, I mean, I think Netflix is probably one of the original companies that prompted me to think about culture. They have a very famous 100+ slide culture deck that I think came out in the early 2000s initially, and they are I think they're the pioneers in thinking about culture. They have a position that is very clear, sometimes counter consensus in terms of how they view themselves. Like, it's this idea that we are a pro sports team, not a family. And they have a lot of sort of interesting concepts that support that. Around this duality of freedom and responsibility. the famous keeper test, right? How hard would you fight for somebody who's going to leave, and that kind of links back to talent density, and a whole bunch of others. They're an interesting example because it's a fairly young company, and they've gone through a stage of founder kind of leaving the executive position. So it's a one where you can kind of learn a lot from analyzing culture.
Yeah, absolutely. I mean, didn't they write a book on it?
They did. I think maybe there's a couple, but I think there's one by Aaron Myers. Mm-hmm. A lot of these sort of concepts are explained there as well, and I think a lot of people use it as a manual for how they might want to adopt sort of culture in their firms.
Yeah, the book's called No Rules Rules, and I think it was joint written with Reed Hastings.
That's right.
The founder, CEO. So let's dive into this keeper test, because it is a pretty, it's definitely different. It's definitely controversial. They talk a lot about sort of talent density, right, as being the key to their long-term success. And they clearly have done a really good job. They have created one of the most consequential media companies in the last century, and certainly came from a standing start, because they were basically distributing DVDs. So they've clearly done something right. So why don't you explain this this litmus test that they have?
Yeah, so I think the kind of the context around it is Netflix felt that as you grow larger, you tend to lose people who are maybe the most creative and want to work in an entrepreneurial environment, and they wanted to keep that talent density high. So the keeper test is a test for a manager that needs to decide how hard they would fight for one of their teammates who would decide to leave and go somewhere else. If they really wanted to keep that person, the manager is then responsible to make sure that that person gets paid top of the market salary, so that it would be highly unlikely that they'd be able to get a higher comp somewhere else. So in a sense, it's a proactive, not a reactive approach to talent management, and that's how they think about it.
Yeah, it's a really super interesting and differentiated approach, and I recall in the book, Reed Hastings talks about how they had to make a really tough decision where they had to do a massive layoff that really spawned this thought process for them, and he felt very heavy-hearted when they had to do that and break the news, because it was, I think, a full third of the company they had to let go, but that the reaction from the employees was actually different than what he expected. They actually had some sense of almost relief that they had sort of less people to sort of have to work with to get the same work done. And I think that sort of drove them toward, this more, this very differentiated process.
Yeah, no, that's a great example, because it kind of ties in with one of the perspectives that I like to look at as, making a tough short-term decision that's good for the long term of the business, right? So the next day is tough, but the next 10 years, you get a much higher chances of success, because talent density goes up, expenses go down, and you have these sort of phenomenal colleagues, right? So clearly, it's not one fit all. It has to be context specific, and it doesn't work all the time. But I think in their case, they figured out the ways that they can apply it thoughtfully, it appears to be working.
Yeah, it's interesting. I would draw a parallel with a company that I know pretty well that may not be known to listeners as much as Netflix is Appfolio, California-based SaaS company that serves the real estate vertical, and they tried to do a product expansion several years ago to get into the legal vertical, and it never really took off. The amount of growth was not what they wanted. It was distracting for the management team, and they made the tough decision to sell that portion of the business to private equity. And as they describe it, it was a tough period for the company, but ultimately, actually, their growth rate has seen an acceleration since they've gotten really focused on just one area and have executed really well. And so it just shows a level of bravery on the part of the management team, in a situation like Netflix, or in this case, where you choose to divest, and it might look like you're going backwards, but in fact, you're actually doing something to give you some forward momentum.
Yeah, no, absolutely. And I think, in a lot of cases, these decisions are made by people who are business owners, like real owners with their own capital, which then changes dynamic around what's right and the guidelines for decision relative to maybe a corporate executive with limited skin in the game. So that's kind of another lens. If you were to run that business and own 100%, how would you do it, right? And if you have that attitude and flexibility to make that kind of decision, then often it's a lot clearer of what the right path is, right?
Oh, yeah. Oh, absolutely. Absolutely. You wrote an article, a very well-written article on company culture and the importance of company culture, and you highlight in there that you have a cultural tapestry. These are the anomalies that are often found in real exceptional companies. And I thought, one of the interesting ones that I would pick out of there and highlight is this the concept of directional consistency. And you want to talk about that for a second, because I not only do I agree with it, I think it's got to be, for me, the top of the list.
Yeah. Yeah, no, I think it is. And really, if you think about an average company, they typically lack directional consistency. Why? Because if you look at the CEO turnover, I forget what the number is, but I bet you it's somewhere around, maybe 3 to 5 years, maybe a bit longer. You can't really do serious, planning around that time horizon. And the costs of switching focus are massive, and they typically linger for years. So if a company kind of changes direction on a 3 to 6 year basis, they're playing catch up to the one that is really knows where it wants to go and is 100% focused on that type of direction. And I think you can kind of see it. You can talk about examples, of that. But that's the one that can really make a difference. I think the one that comes to mind for me is Ferrari. Right? It's very clear what Ferrari wants to do in terms of being the absolute best sort of sports car manufacturer, and their heritage around racing and Italian car design. To me, that's, they've stuck with it, and they know exactly, what they're trying to achieve. The other one that I point out is a Dutch payment processor company, Adyen, they're a startup, so to speak. They're, I think under 10 years old, and they've always, from day one, wanted to do something very specific and intentional in regards to designing for 10x or 20x for give themselves growth, not offering any customization, kind of one solution for all clients, and focusing on total value, and they've kind of stuck with it. So those are kind of the two that pop at the top of my head, but I'm sure you have more in your universe.
Well, yeah, the one that comes to mind, and I don't think that this would be, I think a lot of people probably wouldn't think of it this way, but the one that immediately comes to mind for me is NVIDIA, because they have gone in the same direction. And I remember that company when it was a small cap. And it wasn't even that long ago. I mean, thinking back, I think I looked back, and I think the company was valued, it was a mid cap in, I think 2017. I think it was like 50 billion in 2017 or even sooner, maybe 2019. So, but the thing that has been directionally consistent for them is that they are constantly trying to be an innovator. They're trying to create markets with their technology. Rather than trying to be a competitor, they're trying to be a creator. And so that is built into their culture where they insist on collaboration in order to try to get the best technology to the forefront and then try to push the envelope on it. And I think pretty famously, Jensen Huang, who's their CEO, has made decisions to push the envelope on technology that almost, sent the company to the brink several times over. But that's been, part of their cultural DNA, and so you got to tip your hat to them that they've been able to execute and pull it off, and be at the forefront of creating what we now see out of AI.
Yeah, no, I think that's a very good example, and of course it kind of looks like a no-brainer now with the benefit of hindsight, but I'm sure that when they were in the room making that decision, and as you say, with very high stakes, it kind of felt uncomfortable, right? And that ability to make that decision, which I guess again requires buy-in, right, from the team, and that alignment of strategy is crucial.
Yeah, I think the other thing too that I think we should touch on is sort of the flip side of the coin, which is are there clear signs that a company has a dysfunctional culture?
Yeah. Well, I think I always like this frame of reference where I think Munger was quoting German mathematician Jacobi, like always invert, right? So if you take some of these principles that I use to create the cultural tapestry, the one that we want to see, takes the inverse of that, right? And what do you get? You get reactive, short-term focus. You get frequent changes in CEOs and strategic direction. Oftentimes you get command and control attitude without any context or situationally specific sort of analysis. You often get politics-heavy environment where a lot of time is spent on kind of figuring out who's more important rather than getting to the right answer. And interestingly, you also get maybe not necessarily a dysfunctional culture, but a culture that is not clear or aligned. You get a lot of jargon in communication, and it's often unclear. It's like you read any other report and you just don't understand what are the guys saying. So and I think sometimes it's very clear whether it's maybe not dysfunctional, but we had an example where called up a U.S. media company, and we said like, hey, can we talk to you about culture? We're an investor, a long-term shareholder, and after a couple of days, they came back to us and said, "Sure, we can book you a meeting with our general counsel." Right, and right there, we thought that maybe we're not fishing in the right pond. I think another one, a company that was well profiled in the media, Purdue Pharma, right, the Sacklers, and the fact that the company specifically and deliberately incentivized salespeople to sell maximum dosages of OxyContin. Right, to me, again, that kind of speaks loud and clear around the culture. And maybe more recently, when FTX didn't really have a CFO or an org chart, that's a very sort of clear sign, that the culture might have issues, or building a headquarters that was shaped from the aerial view, like the founder's hair, was also an interesting one. So there is a lot, but you kind of have to apply your lens and look, right?
Oh, absolutely, and it really does start at the top. One of the investors I used to work with, he and I used to always listen for when we would meet with companies, if the CEO or the CFO would sit down with us and we would ask a question about the company, and that person would answer starting with I. So I have margins of 20%. That was always concerning to us, because there isn't any company that is one person, right? So especially at that level, a public company, several billion in market value, et cetera. So that was always a tip off for us, where we would sort of smile and have some reservations about whether or not it's a real team that they are we're actually undertaking together. But there are a lot of companies that talk a good game on culture, but and say the right things and put a lot out there, especially now, given the amount of press that sort of company culture has gotten. And so I guess, at this point in time, it's probably more confusing than ever to sort of figure it out. It really comes down to like watching their behaviors over periods of time, no?
Absolutely, right. It's it's the actions that speak louder, right? And it's certainly over the last 5-7 years, we've had a lot of changes and anomalies in the macro environment, right? Where you had a chance to see how a company behaves in a tougher situation, whether it's COVID, right, or something else, and whether their actions align with what they've told you their culture is and their values are 5 years ago, right? And you can kind of go back and see and how do you sort of reconcile that, right? Mm-hmm. I think that's a lot of these companies, especially kind of larger caps, have very polished, consultants and brochures and usually charismatic leaders that will tell you exactly what you want to hear. But having history, perspective, baseline, and ability to dig a little deeper and look at alternative channels, I think it helps you kind of get more comfortable with the thesis.
Yeah. It's a great point. One of the companies I would point to that has what I believe is, very strong leadership and a strong culture, and they've talked about culture over the long term, is the Trade Desk. And Jeff Green, who's their CEO, I hold in high regard. And one of the things for those that are sort of curious about some of this stuff, and also in the vein of just having alignment through transparency, he does a fantastic job, in my opinion, on all of their earnings calls, giving a very long set of prepared remarks on what's happening in their markets and what they're trying to do and what they're trying to drive and how they see the future of ad tech going. And he's got a very good track record of saying, hey, this is what we see coming, and then it has come. And I think one of the things he probably uses this for, it's a little bit of speculation on my part, but he probably uses it to continue to keep both investors and employees all looking at the same horizon.
Yeah, no, I think that's right. And I think, it reinforces their credibility, right? Particularly like if you had a bad quarter or a bad year, a company like Markel, which is a specialty insurer led by Tom Gaynor, who's excellent, right? They would tell you, like, look, we do well here, but we screwed up over here, and this is our plan. And they won't tell you, like, using some kind of fancy terms or slides to kind of try and move you away from the real issue, which you begin to appreciate when you compare it to some of the other, some of their competitors. So yeah, I think that's a big part of it, and just being upfront, clear, and frank with your investor base and your employees.
Yeah, so let's tie it together to results, right? That's one of the things we try to do in this podcast is think about the things that are maybe not as obvious on the surface. Like you could look at the financial, you could look at the company's products, you could look at their financials, you could look at what they have on the website, and et cetera. But oftentimes the things that are below the surface are the things that add a lot to the repeatability and to sort of the superior financials that you see. We both agree culture is one of those, but let's just talk about the tangible aspect. Like, how does this impact margins over time and returns on capital? It's pretty obvious the growth would come from this, because if everyone's aligned, then they can get behind innovation and new product development, et cetera. But what about the things that might not be as well appreciated in terms of like margins and their ability to generate cash and returns?
So, look, I think it's intuitive, as we've kind of discussed, that culture will drive results over time, right? Because essentially, what does it do? Well, it kind of shapes the balance of happiness between the employees, the customers, broader stakeholders, which then in turn, informs how much excess return is the company able to extract from the market and relative to their competitors. It goes to long-term value creation. I think, to me, looking at our portfolio, the metrics that I kind of focus on a lot is return on invested capital. You can kind of think of it as a true serum of the industry over the long term, right? It's difficult to hide on that basis, and kind of our 20-year average for the portfolio stands at around 14% ROIC, and I think that's compared to about 7.5% for the global index. So you can kind of see the tangible difference between some of the exceptional compounders and the broader median company, if you will.
Yeah, it's a great point. Yeah, I think the place that it will really show up is the employees really doing a fantastic job of executing the plan, so that you don't have, like what in the Netflix case, you don't have employee bloat. So right. Then you'll get, better efficiency for the dollars invested. That's number one. Two, like to go back to the Hermes example or brands, if the company has a great culture that is intertwined with the brand, then the brand will earn a much better gross profit than all of the competitors. Exactly. So you're getting excess margin there, and that's very repeatable. That usually, unless there's a spending problem, that usually will lead to better returns on capital. And so there's a lot of sort of things that I guess, are not things that might be obvious, but are parts. They all go into this formula for finding that return on invested capital.
Yeah, no, absolutely. And I think, it's a well-defined flywheel that you just described, right? And it's very real, and you can trace the elements of it in terms of business model and fundamentals and market analysis, and then you kind of capture it in the end in that ROIC metrics that you can kind of tangibly see, and that's why I have a high degree of confidence around this idea of cultural alpha, which is kind of an important element of the strategy.
Yeah, and it's the most of the excess return that comes from that is sort of in the waiting, right? That go back to the one of Munger's famous quotes. So
right, sit on your hands investing.
That's right, exactly. So all right, well, I think we covered a lot of ground today, Igor. This has been a lot of fun, and thanks for coming on. Really appreciate it. Appreciate all of your insights, and we will. I think we'll wrap it there.
It was a pleasure for me, and thank you for inviting me, Tucker. And I'd love to chat more about it down the road.
Sounds great. Okay, thanks, Igor. Thanks, everyone.
Thank you.
So to sum things up, we had a great wide-ranging discussion on culture. Igor made some great points on the importance of culture and what he calls cultural alpha. A great culture has everyone going in the same direction and they buy into the vision. Also, we uncovered that a great culture is key when you need to make difficult decisions, whether those are like the one at Hermes or when Netflix forces their managers to focus their resources on their best team members and let go of the others. Igor talked about directional consistency being one of the most important aspects of a great culture. And in conclusion, a great culture is earned over time from the behaviors of the organization, not because the company says that they have a great culture. I hope you enjoyed this.